Hey folks, it's Ace in Trading coming at you with another weekend review. And boy, it's a doozy. So I'm just going to go over the state of the market as usual, to go over the way the indexes are looking, the internals as far as the breadth and the momentum, the sectors and the industry groups, and maybe get into some stocks. But not anything promising today. I can tell you that from the start. All right, so last time we had a weekend review, if we look at where we were Friday, which would be this bar here, I did that weekend review over the weekend, and you can see the last 5 sessions have been just a straight up nosebleed. This obviously is not positive action on the long side. I imagine any number of people assumed or thought things would bounce here at the 50-day. As you can see, that did not happen. And as somebody who's been trading for a while, I can tell you this is not uncommon. People seem to think that the 50-day is like some sort of magic wall, but it's more of a general guideline. And when big institutions are in a selling mood, they don't really give a shit about guidelines. They're just trying to dump their shares and get out of things as quickly as possible. So hopefully those of you listening did not fall into the trap of trying to bottom fish or catch a falling knife, or whatever moniker you want to use. That works until it doesn't. And for those of you that don't have the discipline to cut your losses, that's not a great strategy, because then you're sitting there with losses. You're adding to the losses potentially. People in the comments were like, "Oh yeah, well, if you kind of pick the lows multiple times and they work, and then let's say the fifth or sixth time it doesn't work, then you just cut your losses and then you're done." But it's like, that'd be great if in a perfect world everybody had discipline. I would imagine a lot of the folks listening to this right now, if they were not in cash or did not sit on their hands, probably got kind of jacked up in the last week. And that kind of goes into the area of discipline of sitting on your hands and doing nothing when there's nothing to do. That's usually the best course of action. As I stated last week, the signs were extremely negative, and my general approach is I don't like trading on the long side until I know I have the wind at my back. The wind was clearly not at my back, so I haven't been doing a whole lot. So you can see all the major indexes are below their 10 and 20, which are also declining. This is not a good situation to be in. And things will remain in this state until they don't. That things could bounce next week. It could take a month. It could take 3 months. It could take 6 months. Anyone that tells you they know what's going to happen, they don't know what's going to happen, or they're trying to sell you something that makes you think they know what's going to happen. But trust me, they don't know what's going to happen. I've been doing this for a long time, and I still haven't figured out the magic formula for timing the market bounces exactly. And that's not even necessary. It's not necessary to trade successfully. It's just a gimmick that people use to try to make themselves feel better. But the indexes are clearly negative. If you look at the breadth, the internals, you have this, looks like 3 or 4 times as many new lows as new highs. Even the up and down sort of momentum, excuse me, is also extremely negative. So none of this screams at me I should be on the long side at all right now. So I happily will sit on my hands. Same thing if you look at the sector indexes over here and the industry indexes. You can see there's just a clear kind of negative. Technology has dropped all the way to like the 10th out of 11. Consumer cyclical is 9. Usually the biggest winning kind of growth names will come out of these two sectors. Historically, that's been the case for many, many cycles. The fact that these sort of growth-oriented indexes are all the way near the bottom, while things like energy, materials, utilities, industrials, and defensive sort of stuff's at the top, it just kind of speaks to the state of the market. And even these indexes themselves are not in a very good state. If you click on the chart here, it's like the leading index, air finger quotes, is not in a great technical state. Utilities is having this V-shaped bounce. Materials is below its 10 and the 20. Industrial, same thing. You're not going to go down the list. So even the supposed leading sectors are not even leading themselves. They're just holding up better than everything else. And that's one thing I want to like also point out is there's a difference between leading as far as like price momentum and leading as far as like you're just not dropping as much as everything else. There's a big difference between the two. A lot of people confuse momentum and relative strength, and those are two different things. Something with momentum almost always has relative strength, but something with relative strength doesn't always have momentum. Let me repeat that again. Things with relative strength, things with momentum almost always have relative strength, but things with relative strength don't always have momentum. Just because something is holding up does not mean it currently actively has momentum. And me as a swing trader, as a momentum trader, I'm looking at things with momentum, with follow through. And something holding up better than everything else doesn't fit that bill. It could be potentially a tradable thing later on by showing relative strength, but it's not something I would buy just because it's holding up better. Otherwise, I'd be sitting here like trading utility stocks. Like, screw that. Like, I'm not going to trade utilities. I'm not that desperate. But the state of the sectors is not great. Like again, as I pointed out last week, if you just look at the composition of these top 20 or so industries, it's just not a great list of industries that you want to be in. And if you want to like try to find things in these kind of materials areas, then you can see that the metal stocks are kind of leading the charge here. And even if you look at these sort of indexes, this actually is not a bad look to it. It's pulling back to its rising 10 and 20. Maybe you can find a sector ETF, or you can find individual names in the silver or aluminum. Like that's a really good flag right there. Like if this thing were to break out, then this is the industry chart. I imagine there's going to be any number of stocks within that industry group that have a similar look. So I mean, if in this sort of situation where most things are kind of shitting the bed, but these things are kind of holding up, these are the areas, if you're going to do anything, you want to do it in these areas. And you can see that these charts have not fallen apart. They're still rising above their 20-day. So this would be, this sort of area here is where I would focus my attention if you're going to do anything on the long side. Otherwise, just sit on your hands and wait. That's what I would recommend. And then as far as individual stocks, as I said before, there's this very basic scan that I run. We can go through the criteria real quick again. It's just basic relative strength of a couple of different time frames. Some liquidity basics. I think it's 10 million daily dollar volume and 300,000 shares a day, which that's really, really low. That's the minimum threshold. That's not like what I'm ideally looking for. The volatility, you want the 10 to be above 20 and then, not too far off the recent highs. Those are just the basic things of me just trying to see the universe of stocks that meet these criteria and how many there are. And I think even last weekend when I did this, there was, I want to say there was 50 or so. Now there's 33. So like this list continues to just degrade and atrophy week by week. And that's not a good sign. Until this list of high relative strength stocks trading near new highs in an uptrend with the right volatility, with the right liquidity, until that list starts to grow and expand, then I would not expect anything amazing on the long side. Again, that'll take as long as it takes. I'm certainly in no rush, but I know when I see this sort of action, this is not what I'm looking for. When this thing goes from 150 several weeks ago to like 50 to 33, like this list continues to contract as stocks fall below their 10 and 20 and or fall too far off of recent highs. That it's typically what's going to kick a stock off of this list is one of these two criteria fails to meet. And but again, like these are not the kind of stocks I would want to be following and trading anyway. I want stocks that are in an uptrend. I want stocks that are maintaining their ground that they make. If they make a leg up and they consolidate, I don't want them to just completely shit the bed on the pullback. I want the consolidation to be nice and orderly. And I want it to be near recent highs. That way it doesn't have a bunch of overhead supply. And it makes it just that much easier to make an advance when it does break out. So yeah, so that's just the state of the market. Nothing positive on the long side at this point in time. I would also caution anybody to think it can't go any lower than this and it's going to bounce. Sure, it could, but again, those that have not traded for a long time have not seen how ugly things can get when things get ugly. I would not play Russian roulette with the market. Let the market bottom. It's going to take a week or two at least, if not a month or more, for it to have the right sort of price action and consolidate and start building the basing structures that that me as a swing trader on the long side typically look for. So stay safe out there, enjoy your week, and I'll talk to you guys soon.